It's an October recap, and it's a lot. Welcome to the Lowdown. Well, today I've joining me Chris Roberts. Chris, I thought it'd be a great time to bring you on, and definitely we have a lot to go through in October. But one thing we haven't seen in a while, and I thought maybe we could start with this, is kind of that reintro of geopolitical risk. We kind of, got to the back burner for a while, but now I think it's back to front and center. But what's happening with China? Let's talk a little bit about China. What are you seeing that's happening with China that's surfacing now?
Well, I'm glad you brought that up, Mike. And speaking of changes, we finally got the fall weather, so we've got the jackets on.
Yes.
That's a welcome reprieve. So that's another change.
49 this morning.
49. That's right here in Houston. But you asked, what's going on in China? And we saw a big sell-off in Chinese equities earlier this week, largely because Xi Jinping got his third term as the leader of the Communist Party, and that's pretty much unheard of since the days of Mao Zedong, right? So a lot of people have asked, or I've seen a lot of questions. Okay, why did Chinese stocks sell off after this? And it really comes back to authoritarianism, right?
Yeah.
Authoritarianism does not typically promote innovation, right? You need to have freedom in order to generate innovation, and you're just not, that puts a clamp on Chinese innovation. But then also the potential for the state seizure of private companies. We've seen that risk in China for a long time. There's no point in driving innovation if you do that, and then the government comes in and seizes those assets and say, sorry, they're no longer yours. But we've also seen some very odd things in China right around this quote-unquote re-election, and that is the delay of the Q3 GDP numbers and economic figures coming out of China. That was very odd. And so it's a combination of risks all coming in at once that's really led to a precipitous sell-off in Chinese stocks, and in particular Chinese tech stocks, because of those innovation comments that I made previously. But Mike, I just want to point out that and you would second this, right? We get a lot of questions, especially over the last few years with the U.S. debt load and what have you, around, will the Chinese currency, the yuan, replace the U.S. dollar as the world reserve currency, as the world trade currency? And I think that a lot of what we've seen over these last few days is a reinforcement of why we wouldn't see something like that.
Exactly.
Yeah.
Well, I tell you what, you're right, Chris. We get that question quite a bit, and it's one especially, people are concerned about the U.S. dollar, and we keep hearing this many times over. But I always ask the one question back to anyone that asks me, could the U.S. dollar use its reserve status, and could the yuan basically take the place? First of all, that's absolutely. I think there's no way that's going to happen. But what would be your second best currency? What would be the one thing outside of U.S. dollars that you would want to put your money into? And usually the answer I get back is kind of a blank stare.
Yeah.
I mean, no one has a second alternative. But I think right now what you just mentioned about China, capitalism is definitely not in favor there. Innovation is not in favor there. Matter of fact, you're having a lot of capital flight. The Chinese government's been trying to prevent capital leaving. The wealthy are trying to get their money out. That is not a place where capital flows are going to flow into. So I just don't see where the yuan is going to be in any time soon or in the future any threat to the U.S. dollar.
Yeah, and it kind of goes against what they've built the underpinning of their economy on for many, many decades, which is kind of that world producer role. The government strictly controls the value of the currency, at least from an international perspective, in order to confirm their position or just make them the ultimate producer, right? So it just doesn't. It doesn't make sense right now. Hey, maybe 20, 30 years from now, we'll have a different tone, so to speak. But in the short to medium term and even long term here, we expect the U.S. dollar to maintain or continue to be the cleanest shirt in the laundry basket, so to speak.
Well, and I think it's even the cleaner shirt now these days. And look, there's a book, and I want to for anyone concerned about the dollar. First of all, there's a lot of other concerns you should be concerned about than that being the issue. But in 1997, I read a book called The Common Dollar Crisis, and it suggested basically moving away from dollars. That would have been the worst piece of advice anyone could have followed. Keep in mind, currencies unraveling or currencies being dethroned, that is the longest trend and the longest trade to kind of unwind. You're going to have a lot of things happen between that. So I would focus more on what's happening now, which we're going to probably get into, than rather something that could happen many, many years or decades from now.
Well, and just keeping with that theme, Mike, I think, we'll move on to other geopolitical items that have really grappled with the headlines, and that has to do with, just like with your last episode, what in the world is going on in England, right? So I thought we'd draw some adages back to that episode just because a lot has happened since that episode. So
Sure.
as many of our viewers know, Liz Truss, she's now resigned her position as prime minister. She's the shortest serving prime minister in
the lettuce.
The lettuce outlasted her, so to speak. And so, I think that, it really kind of comes back to, I don't necessarily want to talk about what's going on in the UK as much as we'd like to draw some analogies to the United States.
Sure.
And really what they've experienced over there is that they've had their economy was bending, and now it's broken, right? We've talked a lot about how the Fed will continue to bend this economy until something breaks, in which point they will, incite a pivot, right? They'll change their policy actions. And that's precisely what we saw in the UK, right? They whether it be through poor policy actions or what have you, they bent the economy, and the central bank had to step in and change their position and start buying long bonds and to support the pension funds and things of that nature. And this kind of just goes back to, at the end of the day, central banks are really tasked, the rock in a hard place, right? Mm-hmm. They want to get inflation under control and what have you, but they don't want to break the economy by doing so. And so the fact that the UK has taken this more pivot stance, while we don't have the massive public-private pension system that the UK does here, it still shows you that policy decisions can change, and they can change rapidly once the warning signs turn into light up, so to speak.
Well, they chose to become more accommodative, right?
Yeah.
So they gave money to recipients of inflation, right?
Mm-hmm.
So that's more money supply coming into the system. So they actually, in short term, they made created some relief. In the long term, that they're now fueling inflation. The Federal Reserve, you could argue, and it's been painful, but they're raising rates. We've gotten ahead of just most probably other countries out there, right?
Comparatively speaking, I think that we've kind of had one foot in front of the other, so to speak.
Absolutely.
A lot of people have been displeased with how the Fed is doing things, and no one's ever going to be 100% happy. But at least if you compare the United States policy actions with the rest of the world, I think we've really been ahead of the ball there. So I think switching gears, back over to the United States, now that we've talked a little bit about what's going on overseas, obviously October, at least the time we're recording this episode, which is Wednesday this week, markets have been pretty positive, right? We've got about, I think the number here, about a 5.58% return since this time in September. So rolling 1 month of, call it 5.6%. That's pretty robust after what we've seen this year. And I think that, the driver for this rally is multiple things, right? We've seen a pivot overseas. We've seen pretty good earnings results to start, apart from what we saw last night. We've seen some of the tech stocks have some disappointing ad sales and what have you, which isn't surprising in an inflationary environment. And so, we've also seen a lot of technical reasons, for the rally too, kind of like what we saw in June. Going into June's earnings releases and what have you, and going into June, there were in July, there was so much bearish sentiment on the market that once earnings started to look a little bit better than what we were expecting, there was a lot of exhaling, right? There was a lot of relief. There was, i.e., the relief rally. Now, of course, what clamped that rally was the bad data we got inflation-wise in August and September and what have you. And so now time will tell if that happens again, right? Are we going to see a replication of the pattern we saw over the summer? Or are we going to have a little bit better economic data? Or maybe even bad data,
or less worse,
or bad data leading to good results for markets.
Exactly.
Bad news is good news story that we didn't see this summer. So we're watching that, of course. I think the chances of a little bit of this reprieve holding are definitely higher than what they were what they were this summer, just because we're starting to get those earnings revisions for next year. They're not quite as bad as we were anticipating. So again, the United States, at least from a comparative perspective, looks pretty attractive right now. And again, that key word there is a comparative perspective. So.
Well, technically, I mean, we were pretty oversold on pretty much all indices, so we were due for a bounce for one. We're now getting to the seasonally strong period. I mean, this is a seasonally strong period for markets. I mean, we all know that September's maybe early October, but technically September is one of the worst markets. So we're coming out of that. So we were due for some sort of a rally. And like you said, sometimes bad news is good news. And what do I mean by that? Well, you've seen PPI numbers now below 50, so that's kind of recessionary. And why is a recessionary number a good thing? Well, that means maybe the Fed will start to slow down in terms of its rate increasing campaign, right?
Well, and that was one of the big things, I'm glad you brought that up, Mike, that we saw last Friday. Now, while it wasn't technically a pivot per se, what it was is last Friday said, hey, the future pace of interest rate increases after the November meeting will not be at 75 basis points, right? They're saying, hey, we're going to look more at 25 to 50 basis points before we pause. They're going to slow things down. The fact that we even got any indication that there's a slowdown coming from from reputable Fed representatives is a good sign for markets. And that's why last Friday was quite a wild trading day. But once that announcement was made, I mean, you saw into the close, things just took off right into the close. And so again, they're controlling the direction of this market right now, although there are outside influences starting to have more control as well with respects to the underpinning of corporate data and things like that. But I think just kind of moving on to kind of a similar topic, Mike, we talked a lot about bad news is good news, or bending versus breaking and all those things. And I think you sent me a chart earlier this week, and we'll throw it up here on the screen. But housing unaffordability, right? We're seeing unaffordability, rates or index here, at a level what we haven't seen since the Volcker era, right? So we haven't seen since the 1980s, so to speak. So that this pattern looks a lot like it did in the 80s, and I think this lends way to that bend it until it breaks approach, where this is something that's getting very close to being broken, and there's got to be a change.
Well, look at this chart, for instance. So in 1969, I think what came out was called the Rule of 30, right? So it said typical households spend about 30% of their income on housing. So if you look at this chart, you can see where in the Volcker inflation years, I mean, that spiked to 60% of household income was going towards houses. That was pretty unaffordable. But look at where we are now. You see, this is probably the biggest spike we've seen since then. And now housing has become way past that 30% figure number, so it's become unaffordable, just like we saw back then. And keep in mind, as far as inflation, right? The Federal Reserve, Volcker, back then had its locks on inflation. Right now, Jerome Powell, his hero is Paul Volcker, he's got his locks on inflation number. They want to get it back to 2%, which I doubt we're going to get back to that level. But right now, they're willing to let something break. And if you go back to historical, anytime there's been a cycle of inflation and the Federal Reserve has been trying to break that cycle, something gets broken. And housing here could very well be one that gets broken. We know the equity markets have been taking a hit for that. So this is something that I think a little bit more pain is likely here before we actually break inflation.
And we'll touch on it with a few additional charts. But I mean, one of the best things that the Fed wants to do right now is they want to bring asset prices down, because that'll lead to a decline in inflation. Now, one thing about housing that I think we need to keep a close eye on is the national average versus regional averages. Is that even though home prices may decline nationally, what are they doing in the in-migration areas like where we sit right now in Houston, Texas, right? And so when we look at that chart and we say, hey, the rule of 30, so to speak, but prior to that, I mean, we were in the 10 to 20% range. So if we were to revert back to what we saw prior to the great financial crisis, and back to that 20 to 30% range, I think that's more likely as far as the unaffordability index, just because, again, we have so many of these in-migration areas where rates have gone up, but home prices haven't retreated, and they certainly haven't done so in Houston. We don't anticipate that to happen for quite a while, just because of lack of supply, and again, and then also people moving here. So that's just another thing to keep in mind. But I think we've got some additional charts to give our viewers here before we wrap up today's show. And Mike, I know you sent me this great one on the rolling 6-month change in the money supply. So I'll let you expand on that.
Yeah, I mean, the story here, and this is one I've said for when I was on the radio for many years, I said, we've got a robust economy and we've got a growing money supply. I mean, the Federal Reserve, central banks are accommodative. The money supply has been growing and growing, and so with that, you fueled all assets, right? Real estate prices, equity prices, you name it. I mean, crypto, whatever it may be. But I've said for many years, the day you see a contraction in the money supply, that is going to relate to asset prices. And I said one of the biggest macro drivers in general will be the fact that changes, right? And so you can see here on a 6-month rolling basis here, this is the biggest contraction since the data's been put out on a 6-month basis. And so that kind of gives you a little bit of sense of the pain we're feeling. And if you look at even a reversion to the mean, which I doubt here, even if we get back to just kind of in that 3% range, I mean, that's probably likely where we'll get. And I guess my point of this chart is probably the worst is done. I mean, there's probably some more here, but probably the worst is done. And if you look at recessions in terms of the stock market contraction, we're probably about 80% of what a normal correction looks like in the stock market. So could there be more pain? Yeah, I think the Fed's probably going to raise right now another point and a quarter is kind of what's priced in. And if they go against that, obviously that's going to probably shock the markets. But that's what's priced in right now. And I think if anything, we've seen probably a lot of the worst already done.
Yeah, closer to the trough than we are the peak, so to speak. And just in thinking about this chart, the expansion throughout COVID is still one of the craziest statistics we've seen, so to speak. So, again, it's a rapid contraction wasn't necessarily a surprise given the rapid expansion during the COVID times, so to speak. So then we talked a lot about housing, just a minute ago on the program. And so, you had procured this excellent chart regarding, USA's or the United States' residential price index for homes, right? And we're seeing that starting to decline, right? We've had two consecutive declines in that index, where I think the number is about 3.3% decline in average home prices across the country. And so again, it's this is one of the things the Fed is watching, right? They want to bring asset prices down. They've brought bonds down, they've brought stocks down, but housing prices haven't started to come down until very recently. Now, remember one of the key things that at least I talked about with Andre when I was on the show last time, while you were out of town, was that's when we got the big and the inflation numbers and what have you, and we sat down, and Andre and I really focused on inflation and core CPI, right, which strips out food and energy. We talked about how core had risen so precipitously because of the rise in rents, and so as home prices begin to decline now, owner's equivalent rent, as we were talking about before the show, typically lags behind home prices by about 6 months.
Exactly.
So that big core CPI component, that primary driver behind the precipitous rise in core CPI, will likely begin to cool next year if this trend continues for home prices.
Well, this is exactly right. So like you said, the largest component there, that lag 6 months. You also got the National Federation of Independent business conditions in the next 6 months. That's on a decline. So that's about about 6 months as well. You've got freight indexes, which are down significantly, and the Chinese freight index, all that's about, again, 6 months, lead time. So we can see inflation, a lot of the large components are coming down, where 6 months from now, we should see that decrease pretty dramatically.
That's the key right there. Is it's we've always said the Fed is using backward-looking data to make forward-looking decisions. But at the end of the day, we know that this data is being digested by them too. They recognize that probably lends weight to last week's comments about the smaller interest rate increases too. I mean, if you just think about it, is we need to be looking at these forward-looking indicators to determine, okay, when is inflation likely to cool? Just based on these things that lag anywhere between 3 and 12 months behind the statistic itself. So I think that just lends way to a far less constrictive 2023. Hopefully, obviously nothing's a sure thing, but I think we're starting to see some signs that things could become more accommodative next year, and we've been saying that throughout the year. But now we're finally seeing the statistics to help back up that thesis as well.
Well, one thing's interesting when people talk about recession. So you've heard lately a lot of CEOs, a lot of investor gurus have come out and talked about recession. And one thing to remember is the stock market is leading 6 months. The stock market is corrected anticipation of the recession. Once we get the announcement of the recession, that's when the labor market, that's when it takes your job. That's the lagging component of it. So the next big part we're probably likely to see going into 2023 is going to be how it affects unemployment, and then that's ultimately what probably gets the Federal Reserve to kind of calm down and pause for a moment.
Yeah, definitely. And at the end of the day, like you said, markets are forward-looking. And those forward-looking expectations change, but at the end of the day, that's one of the things that pulls countries out of recessions too. Is that change in policy, whether it be fiscal policy or monetary policy or a little bit of both. In this case, it'll primarily be monetarily driven after all the spending that happened during COVID, and so that rally, that rise in asset prices helps lift the underlying economy out of the recession itself too, which is another important reason why markets are forward-looking. So, I think that, we're doing this recording in the morning, and I was having good coffee conversations with other advisors, and this is the first time that I felt like, sentiment's starting to turn around a little bit. It's
the stress is coming down.
It is, like you said. I think like we were saying in the show, I think we're closer to that trough than the peak. There's definitely
not a clear path, but
not a clear path. Definitely some pain in store, but we're starting to see some changes in sentiment more than anything, which is good to see as we head into another new year after what's been a very rough 2022.
Well, I certainly hope the market continues to rally through October. We certainly need the relief. Thanks for joining us, Chris, and we'll see you next time on the Lowdown.
Happy to join you anytime, Mike. Thank you.